Welcome to this episode, where we review recent earnings reports from companies listed on the U.S. stock market and examine what the numbers may indicate about their current situation. The information shared here is for educational purposes only and does not constitute investment advice. You should always conduct your own research and consider your personal financial situation, risk tolerance, and future expectations before making any investment decisions. We'll start with Texas Instruments. The company operates in the semiconductor and chip industry. Its latest results were slightly weak, with both revenue and profit missing expectations. Despite that, the stock rose by about 10%. The main reason behind this move was strong growth in data center demand linked to artificial intelligence, with sales in that segment rising by 70%. Similar dynamics have been seen across the AI ecosystem, including other major chip companies. Expectations are high that AI-related demand could drive stronger numbers in the future. However, the valuation is already elevated, with a price-to-earnings ratio around 35, which is considered high. At this level, the stock appears more suitable for monitoring rather than immediate buying, unless there is a pullback or broader market correction. Next, let's look at UnitedHealth. Revenue growth remained solid, up 12%, but the stock experienced a sharp decline of around 15 to 20% in a single day. The main issue came from the medical care ratio, which measures how much of the company's revenue is paid out for medical claims. This ratio increased from 85.5% in 2024 to 89.1% in 2025, meaning the company paid out significantly more to cover patient care. As a result, profit margins are tightening, which raises concerns about future profitability. There are also external pressures, including statements indicating that government reimbursements for Medicare and Medicaid are unlikely to increase, which could further weigh on profits. In addition, the company faced costs of around $2 billion related to a cyber attack, along with ongoing concerns about fraud, lawsuits, and public backlash over pricing and reimbursement practices. Although UnitedHealth has historically shown strong revenue growth, current trends appear to be moving in the opposite direction. With a valuation still relatively high at a P/E ratio of about 21, the stock does not currently look attractive. Finally, let's move to UPS. After earnings were released, the stock initially rose by about 5% before giving up those gains. Revenue came in better than expected at $24.5 billion. The company has been cutting costs aggressively, including reducing its workforce by around 30,000 jobs. The dividend yield stands at roughly 6%, which is attractive, but a large portion of earnings is being paid out as dividends. Earnings per share were reported at $2.38, which is an improvement compared to recent periods, but still well below the $3.96 reported in 2022. Profitability improved mainly due to cost reductions, even as revenue declined. The company also carries significant debt, totaling about $23 billion. With a price-to-earnings ratio around 16, the valuation looks reasonable on the surface, but the stock remains in a bearish trend and the business appears to be in a recovery phase. At this stage, it may be better to wait and see how the situation develops rather than buying immediately. If you found this breakdown useful and want to stay up to date with the latest developments in the U.S. stock market, make sure to subscribe to the channel so you don't miss future updates.